I'm very pleased to be able to speak today with Michel Löwy, the co-founder of SC Lowy, which styles itself as an independent fixed income specialist investment banking group, and which plays out here in Asia but also globally. And we want to talk today a little bit about the transition that you see taking place in investment banking from the big bulge, the big bucket wholesale corporate banks to very successful independent players like yourself, and where the industry is going today. Thank you very much for speaking to me today. Michel, you started SC Lowy together with your Korean partner in 2009, and coming right out of Deutsche Bank, where you were the head of their distressed assets business. Is that how it?
Yeah, we had two names. You know, distressed asset business was one, strategic investment group was the other.
At which point did you even think that you could actually step outside traditional banks to start what you started? Today, unlike many in your cohort who eventually leave the large banks, who then go out to set up boutique shops, you've gone much further. You've got a very strong institutional client base. You offer your balance sheet when taking part in the programs that you do, and you're expanding your product base. In other words, you are beginning to look like the investment banks that you left. Did you actually see that when you were leaving Deutsche Bank?
That was definitely the goal. The goal for us was to build an investment bank, not exactly like the one we left, but that certainly would have many of the skill sets and advantages that we had. If I look at us versus other boutiques or entrepreneurs that have started businesses, there's a number of large differences, and that explains why our trajectory has been different. If you think about the trajectory, if I may, I think I'd rectify to say, when you look at the people that left banking or bulge bracket investment banking in 2008, 2009, 2010 to build their own businesses, you really have three categories. You have the category of people who have built boutiques and have stayed small boutiques, and they may be reasonably successful at a certain level. The majority of people, though, that tried boutique or left for boutiques have actually gone back to bulge brackets. So I don't know the exact numbers, but certainly over 50% of the people that left banking at the time to try to build entrepreneurial ventures decided that the grass it looked greener, but actually going back to banking was the wisest choice for them. And then there are a couple of exceptions like ourselves that have been able to build a boutique, grow that boutique, and today compete day in, day out on multiple products with the bulge bracket. The reason why I believe we've been successful is because the business we were running at Deutsche Bank was already by itself a mini investment bank within the bank, meaning we were not just traders or investors or originator, but we were doing it all. We were originating product, we were investing in product, we were selling product, we were settling product. The team that I had at the time included salespeople, traders, lawyers, settlement people, all of the different areas. And when you do complex investments, you need to have a very wide set of skills. You need to know how to value an asset. You need to understand legal process. You need to be able to transfer the assets that you purchase. And that's what has made us different.
Into that environment, or did you build it? Did you see yourself actually building that within Deutsche, or was it something that was the nature of the business already?
It wasn't the nature of the business. So if you look back, I moved in the late 90s to Asia, to Singapore actually, to start buying stressed and distressed assets, and then joined Deutsche in '99. At the time, the distressed special situation business was me in Asia, period. And then a couple of people helping me out of London. Suchen then joined me very quickly. So at the time, we grew organically our business from scratch.
Just a pause here, are the global corporate banks wrong in exiting some of these businesses today?
It's a difficult question. I'm obviously incentivized to tell you that they are not wrong. The least competition we see, the better it is for us. I'd say it's increasingly difficult for them to compete in this space.
Because of the capital costs? Because
multiple reasons. Capital cost is definitely one. We transact in liquid assets, in stressed assets. There's high capital costs for the banks. Second reason is people. You need to have highly qualified people to understand those assets, to value those assets, to transfer those assets, to sell those assets. And today, the banking world is not anymore the place of choice for the hardest working and most talented individuals. Why? Because of regulations. The banks have had to offer extremely high salaries to their staff so that they can pay bonuses, because as you know, the bonuses are capped at a multiple of their salary, depending on which jurisdiction, but that's roughly how it works. What it means is that you create a top-heavy environment where people are incentivized to stick around for high salaries. They're not necessarily incentivized to work hard, and they know that their performance is capped. So for young, ambitious people, it's not anymore the environment where you want to operate. And so you would prefer to work for a hedge fund, which has been the choice of many. And we at SC Lowy, we offer one alternative, which is not a hedge fund, where you can work in an investment bank, but where we are not regulated by banking authorities, with the exception of our Korean business because it's a Korean bank. And this absence of regulation allows us to pay people for performance.
How then do you see the dynamics between a player like yourself, which can take on complexity, and traditional banks? What is there a change in role? Is there dynamics evolving?
There is a changing role and there's a dynamic. The regulators have not decided to split banks between commercial banks and investment bank, right? We don't have a Glass-Steagall Act and we don't have a separation yet. But to a certain extent, the increased amount of oversight and regulation and cost of capital has partially achieved that, meaning that the banks that have a very large balance sheet, that pose a systemic risk to the economy, that have a large deposit-taking business, find it increasingly more difficult to run a proper investment bank.
At the same time, what's also interesting, I notice, is that as the global banks are retreating from this space, the regional and domestic banks are sweeping into it because their corporate clients are asking for exactly this service, and they have less of the complexity issues, or maybe for their own domestic needs, they have that talent pool that you're talking about. Do you see that dynamics evolving as well?
Yeah, absolutely. There is a vacuum, and the vacuum is being taken over by people like us and by some of the regional banks that benefit from their network, benefit from their local infrastructure, have an advantage with some local clients, and also see an opportunity to compete in their local market. Now, we want to be global, So we've got offices in New York and London, and a lot of our business is across the globe, across geographies.
And is there a specialization of skill sets that you have that shows up very clearly? In other words, all of your counterparties see you as a skills provider. I mean, as a skills player rather than just as a deal maker.
Yeah, our counterparts increasingly know that when you have something that is complex to value, complex to transfer, SC Lowy is a place of choice. It's a place of choice because we can provide those skills, because the skill set, also because we can do it in a very efficient and quick manner, because we don't have the bureaucracy, we don't have the different layers that you may have in an investment bank. When we met for the first time a few minutes ago, I was sitting in the middle of the trading floor. When at Deutsche, I'd be somewhere in a corner office, remote from the trading floor, remote from the rest of the staff. The fact that we've been able to avoid those layers make us a lot more efficient. And then the third aspect is, how do we communicate? How do we transfer information? Because we are highly specialized, we know exactly who's the right buyer, who's the right seller, who's the right advisor for a certain industry, for a certain business to help us out. That means that we avoid what traditional bulge bracket do, which is to go on a speakerphone or on a massive email list to send information. And we can do things in many ways old school by just picking up the phone and contacting the 2 or 3 investors that really fit that investment. What that achieves is speed and confidentiality, which today you can't really expect from a large investment bank.
Your 2014 volumes in the secondary loan and high yield market was about $5 billion. And 2015 was?
Believe 6.5, if I'm not mistaken. So we were up, a little bit over 20%.
You started. What about the high yield market drove your business and created the opportunities that you had? Or were you eating on a market that already existed, and were you plugging into it, or were you growing into a growing market? And actually, it was a growing market.
Yeah. Well, yes and no. So there's different products, right? So you have the secondary loan, and you have the high yield bond market. The high yield bond market, you're absolutely right. In Asia, in the last 5 years, grew pretty much nonstop. 14 was the sort of peak of the market with record issuance. 15 was a little bit less. In 2016, we'll probably see even less issuance. So we were sort of running the tide of a fast-growing market and benefiting from that. So we were gaining market share as well as benefiting from a developing market. On the secondary loan side, it's very different. It's a very cyclical business. Until 2012, 2013, very active market, primarily in Australia. The last couple of years, it's been a very quiet market in Asia, with commercial banks not selling assets and with corporates generally not running into troubles. The second half of last year, we started seeing a turn. We're still at the bottom in terms of secondary loan volumes. Despite that, we've been able to gain market share and grow because we started from a low base. But the secondary loan market certainly has not followed the same trend as the high yield bond market.
But it's got its own trajectory in that markets are slowing down now, and in various large countries in the region, China, Vietnam, there is a sizable distressed assets business waiting to happen. How are you locking into this opportunity, and how is it evolving? Who are the counterparties that are beginning to take shape right now?
So yes, you're right. We have very optimistic expectations about the size of the business and the growth expectation in the next couple of years. I think it's going to be slow development. Banks in the region, and whether it's local banks or international banks, with their offices here, at the moment do not have a lot of pressure to manage their balance sheet and offload some of their problem assets. And at the same time, conversations with borrowers that are in trouble are at very early stage. So it's going to be a slow development. Where do we add value? How do we differentiate ourselves? Well, it's very simple. We've been doing it through the cycle. I've been doing this for 20 years. I've been talking to the same banks, helping them out, creating liquidity for the last 20 years. I've been talking to the same funds, the same investment funds for the last 15, 20 years about helping them to find investment opportunities and co-investment with them. So for us, it's not going to be a matter of, oh, certainly it's interesting, let's move into that. No, that's what we do, whether the market is at a time where it's high volume or not. What we have done differently and how we've geared ourselves and prepared ourselves for what's coming is by securing additional capital. So we have a much larger balance sheet today than we did even a couple of years ago, so that we are ready for the challenges. In part because we expect so much more to come out of Asia, in part because we've grown a very large business in Europe that we also need to feed.
What do you mean by when you offer your balance sheet? You're not registered as an investment bank. From an advisory perspective, what does it mean when a boutique house like yours offers a balance sheet?
So what it means is that we are a trading counterpart of a bank that wants to sell assets or a fund that wants to buy or sell assets. So we don't provide advisory service, right? So we're not paid for advisory. The way it works is that somebody will contact you, share information with you. You will do some due diligence. We'll explain to them where you think this would transact in the secondary market if they want to enter into a transaction. And if they do, then you enter into a more serious conversation with them and buy the asset. Later on, you then work on offloading the asset or part of the asset to other investors.
But more recently, you've had at least 2 primary issuance of your own.
That's right. That's a completely separate business. So that's a different equation. So you've got the secondary flows on the high yield on the loan side, and then we've added a debt capital market business where we are helping corporates raising primary financing, and that's a separate business that has separate licenses, and that's Chinese walled from the rest of the business where the focus is all to raise primary funds for corporates.
You say that you want to be global. A lot of your contacts and your relationships are in this part of the world. How do you globalize that? I'm sure that in the main capital markets, London and New York, you would be well connected in that way. How are the opportunities coming for you that enables you to globalize what you're doing?
So as you said, first of all, most of our transactions are global, right? Over half of our clients are in London, New York, Geneva, LA, San Francisco, and those are people that we've dealt with for a very, very long time, yeah. Right? And that's why we've got over 20 people that are not in Asia but working in our offshore offices to either distribute or originate or analyze some of our product. The other reason why we can be global is it may sound arrogant, but I often find that we can be much more global than the large investment bank. I'll give you one example, the Middle East. The Middle East is a very big business for us. We've been transacting billions of dollars of loans in Dubai, Kuwait, or Bahrain. If you'd asked me 5 years ago, do you know anything about the Middle East besides where it's located on the map? I would have told you, I don't know a whole lot.
It's actually a highly leveraged part of the world, yeah.
Yeah, because the European banks, the global banks, the Asian banks, the Chinese banks, everybody wanted exposure to Dubai. Everybody wanted the Dubai office 10 years ago. Everybody wanted to lend to the region. And suddenly, 5-6 years ago, that changed. And we saw an opportunity because we had banks starting to call us saying, We've got a problem. We've got this portfolio of loans here. We've got those assets there. Can you help us value that? And we quickly built expertise to try to value that. We quickly got on top of the restructuring landscape in the region, and we started trading. We started buying assets, selling assets. We started creating buyers. It was the same counterparts, just a different product. In the meantime, our competitors that will remain unnamed were still fighting between New York and London and Singapore and Hong Kong as to whose mandate that should be. Yeah. Because nobody has a Middle Eastern mandate, right? So it was sort of in between, and while people were fighting, we were trading billions of dollars. That's so we can be more global and move much faster than some of our competitors.
At the same time, the relationships were all new because the Middle East was just only in the last 10 years it's been coming onto the market. Right. In that regard. So are you now domiciled in the Middle East, in Dubai?
Right. We're still not domiciled there. One of our senior colleagues is in Dubai today, and so we have people in and out of Dubai all the time. But we don't feel the need to have a physical presence there. We are still a small business, and as a small business, I think it's important to sit in the same office. It's important to have that physical interaction with the staff constantly. So for me, Australia is a very big business. The Middle East is a very big business. I would much prefer our people fly there on a very regular basis, but for them to spend over half their time in the office where they can interact with me, I find that's a lot more powerful than having people based in satellite offices.
So in your sphere, in your wholesale sphere, and this is a question from a commercial banking perspective, do you ever worry about liquidity? Or the availability of counterparties to trade and so on? Is there any day that you have an issue on that front?
Yeah, absolutely you do. As a matter of fact, one big risk that my industry is facing is counterparty risk. When you think about it, you trade loans, bankruptcy claims, trade claims. Settlement period can be 2 or 3 weeks, can be 6 months. In the meantime, you take credit risk of the counterpart that you've entered into a contract with. That's why we've got 3 lawyers in our business to expedite this as much as possible, to limit the credit risk that you take. When there's less liquidity, when there's a lot of price volatility, you sometimes see behavior that should not take place, and we can be on the receiving end of that.
I never thought that I'd meet a true blue blood investment banker in 2016. So it's very interesting in that way. Some quick questions on the global economy as you see it and how it's going to play out, and the nature of distressed assets coming onto the market now. China, the slowdown, and the fact that the government is committed to building a debt capital market. There already exists something, except that they haven't formalized it. There's municipal bonds that could be developed, not just in China, but right across Asia. How do you think the market as it exists today is going to create some of these asset classes that maybe don't exist today?
Well, if we look beyond China, and I'll get into asset class later, but I would say what you're describing is not a new phenomenon, in the sense that distressed assets, distressed opportunities arise from what? They arise from massive changes in industries, or massive changes into the geographical or the macroeconomic landscape of a specific country, right? I mean, if you look through the cycle the last 20 years at distressed, it's telecom in the US and Europe. It's yellow pages globally. It's shipping. It's mining currently. It's real estate in the US in the early 90s. So we are used to seeing rapid changes in a specific industry or in a specific country. The Asian financial crisis in the late 90s, Argentina's default and the deval in Argentina in 2002, 2003. So those sudden massive changes create opportunities. It doesn't mean that something is worthless. It means that something has a different value. It doesn't mean that a business has no reason to exist anymore. It means that the business prospect as we saw it yesterday and the assumptions we were making yesterday aren't valid anymore. And that's where we jump in to try to rewrite the map and try to take a view on the future of an industry or restructuring is going to play out in a certain country. So that's what we do, that's what we've done the last 20 years. And the current cycle and China slowing down and its impact on commodity prices, its impact on Indonesia, on Australia, on Brazil, in many ways it's nothing new to us. It's something we do, it's just a different equation that one has to try to solve, to provide liquidity to a market that certainly has no liquidity. So that'd be the answer to point number one. Point number two, in terms of new asset class and new country and new opportunities in China, there are going to be massive opportunities in China for a business like ours, whether it's on primary financing, on secondary trading. We're still very much at a very, very early stage in that cycle. If I look in my crystal ball, do I know what we're going to be doing in China in the next 3 to 5 years? I have absolutely no idea. Do I believe that we're going to be doing a lot there? Do I believe that we will probably need a strong local partner to help us out? Absolutely.
And likewise, other countries, other large countries like Vietnam, Indonesia, even Philippines, which hasn't really come onto the market yet, but these are countries which, Vietnam, for example, is sitting on a very large distressed assets in its banking system. It doesn't have any of the legal infrastructure to trade them at the moment, and yet the government is interested, but not ready because of the politics of the country. Do you find yourself having to go in and do business development? Do you do some frontier work in some emerging markets?
We do some frontier work. Part of it is simply when you get involved in a specific situation that need to be restructured, very often there's a lot of publicity around it. And the experience that you go through, whether it's policy for creditors or not, whether it's policy for the borrowers or not, has very often significant ramifications on how the regulator is perceiving what they need to do. And so that's how we would interact at a very early stage. Now, you mentioned a number of countries. I'd say that India, for example, is at the top of the list for us, much more than a country like Vietnam or the Philippines. Why? It's a much bigger economy. It's a much bigger problem. And it's a restructuring system that's been tested. It's been tested for the last 10 years. It's a legal system that's painfully slow, but that works. So for us, India and China, are sitting at the top of the list. Indonesia is right behind that. Why? Because you've got US dollar debt. Much easier to assess that. You've got a lot of foreign borrowers that are involved. Again, foreign lenders, that are involved. That's our bread and butter. Local currency debt held by local institutions in a country that does not have creditors' protection that's really developed, it's very complex. So we'll dip our toes, but very cautiously.
So almost all your work is in dollar debt. You don't do very much domestic currency.
Yeah, 90% of what we do will be G3 currencies.
And the ones that you do touch, which ones are they? The emerging market currencies.
So at this stage, we've done quite a bit of Korean won. We've done a lot of Aussie dollars. Beyond that, we expect we've done a little bit of rupees and renminbi, and we expect that those two are going to grow significantly. But to be a player in that space, you need to again overcome some regulatory hurdles. It's very time consuming. It takes a lot of time. So while we're very ambitious, we know that if you try to do everything at the same time, you're going to fail. So they are ambitious plans, but they're going to take us 3 to 5 years. They're not immediate.
In building your business in Korea, you've been exposed to the distressed assets, and then and then you bought one, which is the bank that the savings bank that you have. This is almost like the priest marrying the nun, in the cathedral. It's like, was that a temptation that you took on, or is it part of an overall strategic plan that you have for yourself?
It's more of a temptation that became a strategic plan.
Okay. That's an honest man.
Yeah. We stumbled across an opportunity, and the more we looked at the opportunity, the more we realized that it was very attractive and that it could really mix very well with many of the objectives we had.
But there are players that have entered Korea, bought banks, and somehow didn't learn the lessons that Korea is really not what you see is what you get, because debt in Korean culture is all very different from the way it operates in other parts of the world. I mean, I'm talking about commercial banks that have bought credit card portfolios and then found that they were actually plugged into the moneylender network, that kind of thing. So is that a risk that you're taking? Are you happy with where you are at the moment on the savings bank side?
I'm very happy with what we've done so far, and we knew what we were getting into. Korea is a market we know very well. My partner Suchan is Korean. We've been doing business in Korea together since 1998, so we know the landscape really well. So there's nothing there that came as a surprise. But you're absolutely right. Each market has its intricacies. And
what do you do with the retained earnings that you build? You've got shareholder commitments, but what do you do? What are you tempted to use that for besides globalizing your business?
So far as a firm, we haven't distributed any dividends, because we just see very good opportunities for us to expand globally. Korea is one, so that's been one way we've used our retained earnings, but so far everything has been reinvested in the firm because we want to continue to expand. We have the ambition to build similar local presence by building either a joint venture with partner or buying an infrastructure in markets like China or India. And beyond that, in our European business, we are also looking at possibilities in markets like Italy, for example, where you have massive stock of NPL and you need regulated entities to buy those pools of assets. So at this stage, we just see so many opportunities that we'll plan to reinvest those earnings.
Michel Löwy, as a boss, in getting the people that you have, and we've walked through your organization just now, and keeping the talent that you have, are you satisfied that you are able to attract the talent that you want and keep them in the face of competition from traditional players? I can see why some would want to, be part of a boutique, outlet because of the complexities that they can work on. But generally, salaries and seniority and opportunity are also important considerations. How do you mobilize your staff? What is your operating philosophy?
So our philosophy is very simple. People that are successful here would get paid more than they would anywhere else. And they do in an environment which is a total meritocracy, in a very flat environment. Nobody has a title. And it works for some people, it doesn't for others. Generally, we've been very good at recruiting and at assessing who were the right people that would fit and what we're trying to achieve. We've been pretty successful there. There's been some turnover, but as far as I understand, the turnover of our staff is much smaller than it would be with any of our competitors. And we're certainly in an environment now where you can attract a lot of talent, and there's a lot of talent that's available. You also have to, when you look at an historic perspective, I have to say that the first couple of years of our existence was much harder to attract talent. Nowadays, we've got a very good reputation. People know in the market that people that are successful are very well paid here, and that their upside is significantly greater than with any of our competitors, and that attracts all sort of talent. So it's become a lot easier than it used to be.
Michel Löwy, thank you very much for spending time with me.
Welcome. Thank you.
Okay.